All right. Good afternoon, everyone. Welcome from beautiful, sunny downtown St. Louis. We apologize. It seemed that we had a little technology glitch there at the very beginning, so hopefully you all can see us now, or at least see me, can hear me. My name is Dave Finkling, and on behalf of our entire firm of Anders CPAs and Advisors, we welcome you to this afternoon's webinar on updates on the CARES Act and probably what you're all most interested to hear about, the loan forgiveness provisions and how to maximize loan forgiveness with your PPP loan. So our firm is based downtown St. Louis, Missouri, but we serve businesses and individuals not only throughout St. Louis, but across the state of Missouri and actually all around the country. So we know we have folks joining us from all over. So we hope wherever you're joining us from, your home office, your remote office, that it's a beautiful day where you're at as well. So before we jump into the topics today, I do want to introduce the experts behind our panel today, or behind our discussion. So for those of you that have maybe joined us on one of our prior two webinars, you'll see a couple familiar faces. My colleague Dan Schindler and my colleague Paul Ray. They'll be the panelists today as I moderate. Dan is a senior manager in our tax services practice, so he brings with him a ton of experience and expertise on the tax-related provisions in the CARES Act. And actually, quite frankly, in the PPP loan program, a lot of the provisions are based on tax rules. So Dan brings a deep expertise there. Paul brings a very unique expertise to our firm, as just over 2 years ago, we recruited Paul away from the banking world, where he brings 32 years of banking experience to the firm. Never could we have predicted this was going to happen to the world or the country, but we feel incredibly fortunate that Paul is at our firm because he brings an expertise that, quite frankly, most firms and most consultants just can't offer in this topic area. So we're very fortunate to have Paul. Behind the scenes, I can see a lot of you are already using our chat feature to ask questions. Behind the scenes are my colleagues, Rebecca Tucker and Dan Mudd. Rebecca is a supervisor in our tax services practice, and Dan Mudd is one of my partners here at the firm. Since they are behind the scenes, we like to refer to them as the Wizards of Oz here at Anders. So they're going to be typing away as fast as they can, if you can see my fingers. We do promise you, though, if we do not get to your question live in the 1 hour, we will absolutely get back. We'll get all those questions answered, and we'll have them on our resource center. So with that, we'll jump into our first question. And I would like to add that we really do appreciate everybody that has added questions when they registered. And what we've tried to do is really build today's presentation around your questions. So hopefully we've done a good job of that. And the last comment before I ask Paul his first question is we're taking a different approach today with our webinar than I think a lot of consultants and a lot of firms have. There's a lot of information floating around where a lot of people are kind of giving the general guidance, but they're not really diving into it to give really their recommendations and really their practical approach to this. So we as a firm have invested a ton of time and energy and resources into this CARES Act. So we're going to try to give you our practical insights and our practical guidance. So hopefully you walk away from today with some answers to questions that you hadn't been answered yet. So our first question for Paul. Paul, could you give us a quick summary of what the president signed into law on April 24th, last Friday?
Yeah, thanks, Dave. I think everyone was hoping that this second tranche, so to speak, would solve all the problems from the first tranche and answer every question. And obviously it didn't do that. It only really was designed to do 4 things. One, it was going to create an expansion of the existing PPP, the CARE Act. It's going to add $310 billion to that particular loan bucket. And within that, then it was going to take 30 million of that, peel it off for banks to use that were 10 billion in assets up to 50 billion in assets. Then it was going to take another 30 billion and give that to banks, financial institutions, minority-owned banks that are 10 billion and less in assets. So that was the first thing. The second thing it did was it applied $60 million to the EIDL program that ran into a lot of trouble, I think, in the first tranche. And frankly, I still haven't seen today. I was up attempting to get into the website, and it still isn't up yet. But that's got $60 billion that will be made in loans as well. If you remember from our last webinar, that's the one that you apply directly to the SBA on their website. and it still has the $10,000 advance as well. And 10 billion of that 60 is set for the $10,000 advance. The other piece was 75 billion for hospitals, healthcare providers, and then the last amount was 25 billion, and that was set aside for testing for COVID-19, whether it's at the state or federal level. So it really only did those four things. Didn't really go back and solve. They put additional guidance out there on a few things, but that's really the four things that it did, Dave.
All right, well, thank you, Paul. So I think the number one thing that came out of what I just heard from you, I think is what is particularly important for business owners is that first round of funding for the PPP program ran out pretty quick. So the key provision, at least what I'm hearing, is we've got a whole lot of new PPP funding to apply for. So time to get those applications to your bank if you haven't yet. So second question, and we're going to get right in now to loan forgiveness. Question for Dan. Dan, can you give us a high-level summary of loan forgiveness? And then from there, we're going to dive into some really specific questions.
Right. So we're going to be going into a lot greater detail. So I'll keep this one pretty high level. But the crux of things here is, you've received your PPP loan. You want to obtain that maximum loan forgiveness. What are the key criteria? First is using those funds for eligible expenses within an 8-week time period. 8-week time period starts on the date in which you receive the loan funds. The eligible expenses that you can use the loan proceeds for include payroll costs, rent, utilities, and interest on some types of debt. Now, there are some stipulations involved as well, and really there's two key stipulations in that you cannot reduce your full-time equivalent numbers compared to two time periods that we'll dive into further. And then you cannot reduce your overall salaries and wages for a certain group of people that make less than $100,000 on an annualized basis. We'll go into much more detail on each of those bullet points, but that's generally the high-level overview of the PPP loan forgiveness program.
All right, thank you, Dan. So it sounds like we use our loan on approved expenses and we maintain our wages and our employment level. We should be pretty good. That all sounds simple enough, but as you start to peel back the layers on this program, that's where the questions start to come in. So let's really jump now into some of the more detailed questions that will hopefully answer a lot of the questions that came in ahead of this webinar. So first, Paul, for you, payroll is a pretty broad term. So what kind of costs are included in payroll cost towards loan forgiveness?
Well, they certainly wages, commissions. We talk about other payments that are subject to payroll taxes for employees. Obviously you can read in and out of the bill and determine a lot of different things, but that's one that's clearly stated. Overtime for your hourly workers, that counts as well. We want to make sure that we're not shorting ourselves. We want to get maximization around those payroll costs. One thing to note, though, the employees must reside in the United States, so want to make sure that we've documented that as well. Other things out there, miscellaneous benefits such as vacations, health insurance, retirement plans, state unemployment taxes, local taxes. Thing to be careful of there, your federal programs, federal unemployment taxes, Medicare, those aren't included in that, so make sure you keep that at the state and local level. So if you combine those things with what you were approved for as well, you'll be consistent in your forgiveness.
Thank you, Paul. And that's, I think, where a lot of questions have come in is, it seems pretty obvious that the wages you pay your employees would count, but it's really nice to know all the other things that could be included, all those different types of benefits, because for most businesses, the base wage is not a nominal percentage, but there's a large percentage of other costs that go into employing folks. So thank you for that. So Dan, Paul started to allude to some taxes that we don't get to include. Are there any other types of expenses, or what are the other types of expenses that we exclude from our payroll costs when doing our calculations?
So clearly, as Paul said, what is included is wages to those that reside in the U.S. So one of the things that is excluded is those wages and compensation paid to any employees outside the U.S. While you can include the gross wages for your U.S.-based employees, you cannot include, so you have to exclude the employer's portion of payroll taxes. So there is generally Social Security and Medicare withheld from the employee, but then the employer also kicks in their half of that to get the total payroll tax number. The employer portion is not included as eligible payroll costs. Further, any compensation paid to any one individual in excess of $100,000 on an annualized basis is excluded. So you can include up to $15,385 for any one employee's compensation. That $15,385 is $100,000, which is the maximum, divided by 52 weeks in a year, multiplied by the 8-week period you have to use your eligible loan proceeds. So the maximum is $15,385. Any excess is not included in your payroll costs. Further, any workers' comp fees, any other expense reimbursements through payroll, and fringe benefits such as employer HSA contributions, commuter benefits, short-term, long-term disability benefits, life insurance benefits, those are all excluded as well. The Act it basically includes the specific employee benefits that are included, and that is just the group health insurance benefits and the retirement plan benefits that Paul previously discussed.
All right, thank you, Dan. So really what it is whatever we applied for, those type of expenses are really what we're tracking now on the back end. Is that kind of my understanding what both you and Paul have said?
I would say in general, that's exactly correct.
Okay, perfect. And what I will add to on this slide is a lot of the questions we have received relate specific to owner compensation, employee bonuses, and those sorts of things. We do have a few questions a little bit later in the presentation to address those specifically. So if you did have questions specific to owner compensation, employee bonuses, those sorts of things, we are going to address those as we get a little further into the presentation. So payroll's our biggest expense for the PPP loan program, but there are others, of course. So Paul, question for you: what type of expenses would be included in the rent bucket?
That seems the easiest to answer, because 98% of the time it's going to be rent on your building that you're running your business out of. But one of the things that has certainly popped up, and there's differencing of opinions on it, but we certainly believe, because the personal property name has been tagged out there a little bit, lease agreements on things such as, let's say it's a trucking company where there really isn't a building, the lease is on the truck itself, and that is its place of employment. So those types of things can be used as well. Certainly you don't want to use rental cars that employees run around in for their job, things of that nature. Those would certainly come maybe under the transportation bucket later on down the road. But this specifically talks about lease agreements. So as I said, we think 98 to 99% of the time it's rent on your building. But we have also seen where it can apply, using that example of trucking firms, things of that nature, that's primarily the business activity. It's out of there, and there is a lease agreement on anything that's put in place prior to February 15th of 2020.
Okay, thank you, Paul. That was something that was early on in the program when you and I talked about this, was really helpful to know, because I'll be the first to admit that I thought it was just rent on buildings this applied to. So when we get to start including rent on lease obligations on other personal property in the business, for some folks out there, depending on your industry, that could be a significant amount of the loan for you.
Yeah, and we want to be careful not to think that implies that rental on your photocopier or those types of things. That's not really what this is designed to do. It's around the place of employment, and that truck may take the place of that building.
Exactly. I think that's the exact right way to think about it. So one of the other reasonably large expenses that businesses will incur from an overhead standpoint are their utilities. So Dan, could you give us a rundown of what utility costs are included as part of the PPP program.
And as listed on the slide, the CARES Act specifically referenced certain utilities that qualify, and they are electricity, gas, water, telephone, internet, and transportation costs. All of these utility costs must have an agreement in place prior to February 15th of 2020 to qualify. So for example, if you have a building and you are just now getting electricity in that building as of March 1st of 2020, that electricity bill will not qualify as utility costs. So the agreements have to be in place prior to February 15th of 2020. I would say the transportation costs is somewhat of a gray area. We're still waiting on a little guidance in terms of what that means. I would say the best practice should be to use the loan proceeds for what we know that isn't gray. We know, electricity, gas, water, telephone, and internet are pretty clear. So I would focus more on those costs as utility costs to use the PPP loan proceeds for. At the end of the day, a lot of it could be a moot point when it comes down to the amount of loan proceeds you must use towards payroll costs and the other range of other eligible expenses, such as the rent expense and interest on some debt that we'll talk about as well. So while there is still a little gray area in terms of that transportation cost, I think you'll be able to obtain full loan forgiveness in most cases without having to utilize that specific utility.
Dan, I think that's a really good point, and probably a key point to make as we talk through these slides. A lot of the questions coming in are I don't say in gray areas per se, but might be trying to push the boundaries a little bit. And I think what we've talked about as a firm, and we'll talk about this a little more detail later on, is let's look at all the expenses that we know do qualify before we get too wrapped up in the minutia of like transportation costs. So let's add up and let's project out all the costs we do know that will qualify: payroll costs, rent, and other utilities. If we get over our max loan forgiveness amount, we don't have to worry about some of these other finer details. So I think a lot of folks, and as CPAs and advisors, we get caught up in the details a lot, and we want to understand everything to the nth degree. But if we can get across the finish line with the big amounts, with the payroll, with the rent, we don't have to worry about some of these other things. So that's kind of been the advice that I've been giving to a lot of folks is, the details are important, but if we can get across the finish line without wrapping our minds up in all these details, sometimes that'll help us sleep a little bit better. So the last item, Dan, that you had talked about, and I'm going to ask Paul about this because he's the resident banker in the house, is you mentioned that some types of interest can be included in our PPP loan forgiveness. So Paul, can you talk us through what types of interest expense would be included for PPP loan forgiveness?
Sure. The funny thing about this is that this is probably one of the broadest categories that's out there. It talks about interest on mortgage obligations incurred before February 15, 2020. What does that mean? Well, just like the rent, it would mean mortgage obligations on a building that you own. It also could be on a line of credit that you have with your bank, and they have your house as collateral. Okay, there's a mortgage filed there. You couldn't use and pay your interest on your personal first mortgage, but you could use the interest on that line of credit at the bank because it has a mortgage attached to it as well. It may be a second or a third mortgage, but it has a mortgage. The other piece that is a little confusing at this point, but I think most advisors and attorneys have gotten to the point of understanding what real property versus personal property means. And I think we all get those confused a little bit. Real property, real estate, is going to have a mortgage or a deed of trust associated with it, but the personal property can include something that is filed as well. It's a UCC1, which is Uniform Commercial Code, and it's a document that's filed against personal property, maybe a large piece of equipment or something of that nature. So it's been interpreted, because the law states exactly as it says, debt secured by real property or personal property. So reading between the lines, something that's secured by a UCC1, being a filed document, would be eligible for that as well. I think the spirit of the law is trying to say we're not going to include unsecured lending in that unsecured debt. We're certainly going to include or exclude credit card debt, interest as well, because that's unsecured. It was already incurred by the company. They're going to have to pay for it anyway. So I think just clarifying the interest is at least a point that we're waiting for more guidance from the SBA. But if you read the law the way a banker or an attorney might read, the UCC is an opportunity as well.
Thank you, Paul. That makes sense. And this is another one of those areas that you and I have talked about internally that I thought was a pretty narrow expense category when the law first came out. And then as we started digging a little bit deeper and pulling in your banking expertise, started to realize that there are more opportunities here in this one particular expense bucket than we originally thought. So I appreciate you going to that level of detail. So at this point, we've kind of summed up, or we've gone into some level of detail on Dan's original question or Dan's original response about the approved expenses we can use. The next part of the presentation is going to cover a lot of folks' questions that we see coming in live here and questions that were submitted beforehand. And that gets into the wage reduction provisions and the full-time equivalent provisions related to the law. So Dan, since you kicked us off, could you please give us a little more detail and expand on the wage levels and what that really means and what the rules are there?
Sure. So you've used all these loan proceeds in some manner or another. You think all's fine and dandy. However, as we've talked about previously, there are two reduction clauses that, in essence, reduce your eligible loan forgiveness amount. And the first one of those that we'll go through is the reduction related to salaries and wages. Now, this clause is only applicable to those employees making less than $100,000 on an annualized basis. So what it says is you cannot reduce anyone making less than $100,000. You cannot reduce their wages by more than 25%. And if you do, part of your loan amount is not going to be eligible for forgiveness in a prorated manner. If you have someone that's making $500,000, you're eligible to reduce them to whatever number you would like, and it would not be impacted in this calculation of reducing your loan forgiveness amount. So be aware, if you're planning to cut pay for individuals making less than $100,000 and you're trying to obtain the full maximum loan forgiveness amount, make sure you're not reducing their compensation by any more than 25%.
All right, thanks, Dan. And that clears up a lot of the questions that came in ahead of time and that are coming in now. There's kind of a get out of jail free card as it relates to the wages, and we'll talk about that in a minute. But before we jump into that, because that kind of get out of jail for free card applies to the full-time equivalent test. So Paul, I'll hand it back over to you. Could you talk us a little more detail about the full-time equivalent test and how that plays out, what the measurement periods are? I know there's a lot of dates and amounts that get thrown around on this one.
Yeah, and all I would say on this one is, and again, it seems like we say this with every slide, and we expect some additional guidance. We hope sometime soon. But when we look at the employment levels that you had when you qualified, you really need to stay consistent with those same employee levels when you apply for forgiveness as well. Whatever you use to justify initially, you want to use to justify in the end as well. So if your full-time equivalent level is reduced during that 8-week period, then obviously your loan forgiveness is going to be reduced by that percentage reduction in these FTEs or the full-time equivalent. So just be cautious about that. So what is the measure? Well, the 8-week period against the lesser of 2 periods is where you really want to measure, and you kind of get to pick the one that works for you. They're really designed to cover seasonal employment versus not seasonal employment, but you're eligible to use it irregardless. February 15th of 2019 to June 30th of 2019, you can measure it against that period, or you can measure it against the period of January 1st, 2020 to February 29th, 2020. Take whatever that particular amount was, compare it, and we'll go into a little more detail later on, but compare it at that June 30th deadline. If you stay consistent with those, you're going to be fine.
Yeah, and that's to clarify one thing. on that, the full-time employment level, when you're looking at the lesser of those two periods, when you're using this as a baseline of your comparison, you need to compare your average full-time equivalents during that full 8-week period in which you're to use your loan proceeds.
You know, it's something else, Dan, I did forget to mention. There's been a lot of question around what does full-time equivalent mean? And the only thing we have to measure it against, and we've heard this from many different advisors, because it is a federal program, the Affordable Care Act says 30 hours is a full-time equivalent. We haven't seen that in writing. So what we're asking folks to do is, again, be consistent on that comparison. If you used 40 hours as a full-time equivalent in applying for the loan, use that same 40 hours in forgiveness. However, that 30 hours we believe will be there as well. So we just hope there's more clarification around it. But right now, that's where we're at.
All right, thanks, Paul. And I hope I've seen a lot of questions come in related to the full-time equivalent test and also the wage test and what that measurement period is, or what the included period is. In that included period, what I'm taking away from what you said, Dan, about wages, and Paul, what you said about the full-time equivalents, is our 8 weeks starts, effectively once we receive our funding. Is that correct?
Yes, that's how I
Okay.
understand it.
Yes, I think that's. There's been a lot of questions around whether it's the funding date, whether it's the date you were approved. So we're very confident it's the date you were funded. So that, I think, clears up a lot of the questions I see coming here live as we go.
One thing I didn't mention on the previous question that is relevant and maybe answer some of the question that you just referenced, Dave, that was coming in, is you're looking at the employee's compensation or hourly rate for that 8-week period, and you're comparing it to the most recent full calendar quarter. So, for example, if you're applying for the loan right now and you're looking at what your salaries and wages are to employees, you're looking at it on an employee by employee basis. Generally, there are some other stipulations, but generally looking at on an employee by employee basis that is compared to that employee's compensation for the most recent full calendar quarter. And as of right now, that would be the first quarter of 2020.
Right, that's a really good point of clarification, Dan. And I don't know if you intentionally did this or not, but you did give a very nice segue to the next question for yourself. So we talked about maintaining wage levels. We talked about maintaining full-time equivalent levels. But as everyone is very well aware, depending on where in the country you live, certain industries have been completely shut down. So businesses have been shut down. Certain states are starting to reopen or will start to reopen, but it might take a while for them to reopen. So a lot of the questions that we've been seeing relate around, well, what if my wages aren't where they need to be early on in the 8 weeks? Or what if my full-time equivalents aren't where they need to be in the 8-week period? So I think I mentioned kind of tongue-in-cheek about the old Monopoly get-out-of-jail-free card, but I do think the PPP loan program has a couple get-out-of-jail-free cards related to wages and full-time equivalents. So Dan, if you could talk us through those get-out-of-jail-free cards, how that works in terms of being able to restore wages or full-time equivalents.
So, for example, if you have let go or furloughed a bunch of your staff between February 15th and actually yesterday, which was 30 days after the enactment of the act, if you let go of a bunch of employees and really there's no way for you to get your average monthly full-time equivalents to be that of one of those two time periods previously discussed, there's a get out of jail free card in that if by June 30th you restore your full-time equivalent count to the full-time equivalent count as of February 15th of 2020, that the reduction in FTE clause will not apply. Similarly, if you reduce someone's compensation who is making less than $100,000, say you reduce it by 50%, well, you're going to be subject to some reduction clauses. However, you can restore the salary levels of those employees by June 30th to be what they were prior to COVID, so basically as of February 15th of 2020, you will not be subject to the salary and wage reduction clause either. So these get out of jail free cards are very helpful and something to consider. Working with a lot in the hospitality and restaurant industry, this is something that will certainly be applicable to them, something that they will want to keep an eye on very closely and do some planning for the next 8 weeks and really through June 30th, if that's in longer than 8 weeks, that you will meet these get out of jail free exceptions so that you're not subject to those previous reduction clauses we discussed. Now, it is important to note if you fail both the FTE and the salary and wage reduction clauses, one of those exceptions of restoring, FTE equivalent by June 30th does not get you out of both of the reduction clauses if you were to have reduced salaries and wages in excess of 25% as well.
Dan, I think that's a really good point of clarification in terms of looking at both of those get out of jail free cards kind of on their own merit, that is. So if your wages drop below the threshold in the 8 weeks, you have to bring your wages back by June 30th. If your full-time equivalents drop during that 8 weeks, you have till June 30th to bring your full-time equivalents back. But one doesn't really cancel out the other, so you have to be looking at both of those rules.
In essence, there's a lot of different dates and dollar figures and percentages here. It really does take quite a bit of planning in conjunction with your bank, your CPA advisors, whoever's helping you get through this PPP program. There's quite a bit of planning that does need to be done, and I wouldn't take it lightly because in order to achieve that maximum loan forgiveness, you do want to dot your I's and cross your T's and make sure you're doing things, by the book.
Right, Dan. I completely agree with you, and I think next time we're going to have you moderate because you're the king of segues today. So on your last point about crossing your T's, dotting your I's, doing all the accountant stuff, a lot of the questions that we as a firm have been receiving, I personally have been receiving from clients and that are flying in here on the Q&A relate to, actually how are we going to report on the back end? So how are we going to report to our bank? What's going to be required to achieve loan forgiveness? Other questions, will there be an audit of my records? So Paul, given your banking experience, can you give us kind of your guidance on what's going to be required to achieve loan forgiveness, what we think is going to be required to provide to the bank, and just kind of talk us through that process?
Sure. This comes directly out of the statute that there will be an actual form. That form has not been released yet, and it will be an application. So you will apply for forgiveness. It's not going to happen anytime soon, obviously. The focus is for you to make sure that you've kept all the records that are appropriate for forgiveness. We have a loan forgiveness calculator out on our website at the COVID-19 resource center that we have, and there are tons of these things floating around in the industry. Certainly utilize those types of tools to help you through that process, but keep all your records. Make it easy for your banker, because as easy as they have it in supplying it to the SBA, the easier forgiveness will occur. So one of the things that was interesting in the statute is that liability has been taken off of the banker's back in calculating the forgiveness. That is an application that you will fill out as a recipient. You will certify that you followed all the rules. You will provide all the information that we're talking about now, especially on the salary FTE side, the same that you applied for in getting your loan. You'll use that same documentation. So I would almost envision in a pile, you've got the application on top, all of the documentation and anything associated with that. You'll submit that to the bank, and then they will apply for forgiveness for you. It's not their responsibility to verify all of that documentation. You have a nice banker, they may help you through it a little bit, but it's your responsibility to make sure those records are kept appropriate. and that the magical number is that 75% of the loan proceeds that were spent for payroll costs. If that's there with the application, then there should be any reason that you wouldn't achieve total forgiveness. There's going to be a time period. There actually is a 60-day time period that they're going to have to get through this whole approval process with the SBA to grant forgiveness. So that's one of the reasons why it's such a long time that any payments would be made on the loan. They're deferred for 6 months. So you won't be making any payments. You'll just be waiting for that approval to happen. Once that happens, the SBA will pay the bank and their fee. Everything's clean and you're ready to go. I know that it sounds easy on one hand, but on the other hand, we all know they've got a lot of work to do to figure that out between now and then. If you keep your records in order, it's going to go a lot better.
Yeah, Paul, I 100% agree with you in terms of the record keeping on this. And also in terms of the the quote unquote packet of information we're going to provide to the bank. So from our experience as a firm and my personal experience working with tons of clients on the upfront application process, is the businesses that had their PPP application put together in a very organized file, had very clear documentation, had very clear calculations. Basically, those clients that really teed this thing up on a silver platter for their bank, they tended to fly through the process pretty quickly in terms of loan approval. So I think the same logic would really apply on the back end, that if we have a very meticulous file that we've kept, whether we've kept an old school paper file or whether we've done an electronic document file, one way or the other, if we have a very meticulous file, if we have meticulous tracking, if we have meticulous records, and we turn that application for forgiveness in with that high level of record keeping, it sure seems like on the back end loan forgiveness will go much smoother for us than if we just kind of wait till the very end and try to catch up. So I think your point is very well taken, especially for those of us accountants in the room. Most of us here, record keeping is always key, but I think for business owners right now, especially those that may not have always had the tightest of record keeping, I think this is one of the times where we're really focusing on record keeping, and quite honestly, probably keeping more than we might actually need is going to be very beneficial to achieving maximum loan forgiveness.
Yeah, and Dave, the thing I would say, and I preach this on non-PPP loans for our clients as well, be prepared to approach your bank from a position of confidence and strength versus weakness. So if you do these things, you'll be able to do that and make the whole job easier.
Yeah, Paul, I think that's a very, very good point. And hopefully before we have to go to our banks to present this packet of information, hopefully we can all get haircuts and get shaven before, so we look professional too. So question 12 kind of plays off of Paul's record keeping question, and I'm probably have gotten this question from every single client that I work with, any friend or family member that owns a business, and we've seen it a whole bunch here. And that is, do I need to maintain or open a separate bank account for my PP funds to be deposited in? So Dan, I'll hand that one off to you if you don't mind addressing it, please.
Yeah, and while there's certainly no requirement for opening a separate bank account, it definitely provides an extra layer of protection and clarity so that you ensure there's no really commingling of funds. And what you want to do here is make sure we're keeping everything in order to make it as easy as possible for the bank or for the SBA to approve your loan forgiveness. So having a separate bank account is something, I don't know if it's a firm-wide recommendation, but I think I would certainly recommend an extra bank account for these PPP funds. It makes it so much easier to track those funds and kind of maintain that appropriate percentage to ensure you're using 75% for payroll costs. If you have this separate account, you can either pay expenses directly from it or reimburse your operating account. I wouldn't be totally opposed to actually reimbursing your operating account for everything, because, for example, when you pay your payroll tax deposit, it generally includes your employee and employer portion. So if both of those funds come from your separate PPP loan account, you're going to need to reimburse that PPP loan account from your operating account, because the employer part of the payroll taxes are not eligible expenses. So perhaps with having a separate bank account, the best practice may be moving funds from your PPP account to your operating account as you pay them.
Dan, great point. And I wish I came up with this saying on my own, but there's an attorney I work with years ago that gave me this expression. So I think of this bank account question as really the old belt and suspenders approach to the PPP loan program. So we don't think you're going to have one, but for those that are being a little extra cautious on making sure they get the maximum loan forgiveness, this is the old way to put the belt and the suspenders on, have good tracking and have the separate accounts. So not required, but it certainly can't hurt, and it would definitely make things easier, to Paul's point about nice, clean record keeping for your banker. So we've got about 14 minutes left now, several questions to get through, so we'll try to make these as quick as possible. But Dan, I'm going to ask you question 13 because there's a lot of tax related provisions built into this question, and this is one of the most common questions is, can the business owners themselves be paid with PPP funds? And if so, how can they be paid?
Absolutely. That is, it's a very common question, like you said, and the answer is absolutely they can be. They can be paid, their normal salary up to that $100,000 on an annualized basis. So for C Corps and S Corps, where the owners are on salary, in the S Corp situation, they will be compensated and paid from the PPP funds through their normal payroll. It gets a little trickier and a little grayer, at least right now, for LLCs, taxes partnerships, or single member LLCs, so proprietors. The answer is yes, you can pay the owners with these PPP funds. The follow-up question we get a lot of times is, well, how do I prove that? Or in what form do I pay that? The guidelines that are at least out right now, which are certainly, hopefully not the final guidelines. We'd like a little bit more clarity in this regard. But for LLCs, taxes, partnerships, I suspect the PPP funds would be used or paid out in the form of a guaranteed payment or distribution, if that is how it is typically paid. The PPP loan proceeds, it is specific, the term owner compensation replacement is specifically used. So in whatever form the owner is typically compensated, I suspect will be how you use those loan proceeds. Single member LLCs or sole proprietors, if without any employees, generally they just take what is called an owner draw. In order to prove that owner compensation replacement in that scenario, I would probably recommend the funds are in your the PPP loan funds are in your business bank account. Transfer those funds to your personal account. You should theoretically be having a separate bank account for your single member LLC. And I would just move those funds from where the PPP loan proceeds went into your personal account as substantiation for your owner compensation replacement. Now that is all as of what we think as of now. It is totally not clear as it stands today, but that's our best guess for the time being.
Thank you, Dan, and I certainly do think it is within the spirit of the PPP loan program that those owner payments for the sole proprietors and for partners and partnerships, that those will be included, only based upon the justification that they were included on the front end when we applied. So we're confident that they will. Not 100% certain, but pretty confident on how we should pay those. Either is those guaranteed payments or draws, but we are confident they're going to be included. It's just a matter of exactly how they get paid. So for our partners and LLCs out there, hopefully that helps you out a little bit. Question 14, I'm going to hand it over to Paul. This is going to sum up probably 10 or 15 different questions we've been asked. And that is, if I have to have 75% to payroll, or if I'm coming up short, can I include employee bonuses, employee vacation payments, or other types of payments to try to increase my payroll during the 8 weeks? So Paul, can you please walk us through what we can and can't do in this area?
Yeah, Dave, this is one of those, again, we get to preface with, we're not ashamed to say we don't know in certain areas because there is no guidance. So what we believe is that from a common sense perspective, doing things to get you to that, they are all acceptable. If for some reason in an audit, it's determined that it's not forgivable, worst case scenario, it's a 1% loan paid over 2 years. No one likes to have that, but our belief is that you should be conservative in the method you have, but certainly when it comes to employee payments, there's a whole range of things that you could interpret out of the guidance. So we believe that certainly bonuses that were incurred and will be paid during that loan period, because it's all around cash payments that are going out during this 8-week period. It's also about not prepaying something. So we would encourage you to be cautious about prepaying things that you normally wouldn't prepay around annual bonuses, things of that nature. But certainly we have many clients that are going to use this opportunities to put in retention bonuses. You've got great employees that are hanging with you through this process. That would be in the normal case of business. So using things such as retention bonuses, spot bonuses to encourage employees to stay and run through this difficult time with you is not out of the realm of possibility. It's certainly common sense would tell us that you could do that, because mathematically we know there's going to be a gap here anyway. So how do you fill that? And certainly these are ways you can do that. Vacation pay, all of those types of things are appropriate as long as you're paying it in the normal 8-week process that you would. So I would just encourage you to sit back and ask the question, is this truly a prepayment, or is it truly something that we would do in other times of issues that we have, maybe not to this degree, but have we included retention bonuses before? Have we given spot bonuses? Certainly. So I think it's pretty broad of what you can do in here. Just make sure that you're keeping the records that are appropriate, because if anyone tells you that they know exactly the answer to this, they're not correct. It's broad. So we're just trying to bring in some common sense ideas that will make sense, keep it documented. We think you're going to be fine, because you're certainly not using it for illegal or non-forgivable activities, in our opinion. And if they list that it's not forgivable, then at least you've done everything you can do to get it taken care of. So keep those records. You're going to hear that over and over and over again.
Right, Paul, I think your point's well taken. Record keeping is key to this all. And I think that the practical application of what you just said is, we don't want to go on record saying we're prepaying anything, but if something was earned and incurred in the period, well, we can certainly make sure we get it paid. So if we calculate our annual bonuses based on the weeks or the months, we can certainly pay that part of the annual bonus in the period. If your employees are working extra hard from home or working extra hard due to the stress of COVID, we pay them those merit-based bonuses or retention bonuses. So there's certainly quite what we feel are legal ways and justifiable ways to pay additional salaries, pay additional bonuses during the period that will help you hopefully increase your wage level. So next question, over to you, Dan. Another very common question, and that hinges around this concept of really paid and incurred in the 8-week period. People are getting hung up on, and rightfully so, getting hung up on which is it? Is it paid, incurred, both, one, the other? So we kind of break that into 2 buckets. So how would we handle costs that are either quarterly or annually that were incurred in the period but not paid until after the period? And then also, how would we handle costs that were maybe incurred before the period that were paid in the period? So can you walk us through both of those situations?
I'll walk you through both these situations to the best extent I can. As you mentioned, Dave, people are wondering, is it paid, is it incurred or paid, incurred and paid, one or the other? We frankly don't have clear guidance. We don't know for certain. However, what we are thinking and how we're interpreting things to be right now is the government has issued these potentially forgivable loans to be used in an 8-week period. You use the funds in the 8-week period without prepaying anything. So, for example, health insurance and retirement plans are a couple common expenditures that would be paid either quarterly, semi-annually, annually, whatever it may be, and it may not fall within the 8-week period. To be conservative, let's operate somewhat under a cash basis without prepaying. And on the cash basis, if you have incurred during this 8-week period X amount of health insurance costs or X amount of retirement plan contributions, go ahead and pay those that are eligible or that were related to the 8-week period. So make a partial payment as opposed to maybe waiting till the end of the quarter or the end of the year or whenever it is typically made. What I would not do is pay the entire year's worth health insurance expense in the 8-week period. There is certainly an element of prepayment there, which that is not what the funds were necessarily intended for. So if you are making any prepayment, or not prepayments, if you are making any partial payments, make sure that those partial payments really do relate to this 8-week period after you receive the loan proceeds. If costs were incurred prior to the 8-week period, such as payroll having a cutoff prior to when you received your PPP loans, and it's not paid until the first week of your PPP loans, I think it's going to be totally fine to use to count the full payroll in the eligible costs, because you should be getting credit, assuming you're paying, you should be getting credit for 8 weeks of payroll. So it could be a timing difference. If you pick up, the payment in the first of your 8 weeks that maybe relates to a few days prior to your loan being funded, you're probably going to be missing out on some of it in the back end because you're paying after that 8-week period. It should all average out from your traditional payroll. We do think it's probably a good idea to keep track of the days in the event it is only incurred in the 8-week period. So, keep track of how many days may have been paid in the 8-week period that were for a few days prior to the loan origination. We don't think it'll be necessary, but you'd rather be safe than sorry.
Dan, I think that last point might be the most important out of that whole slide, and that is, yes, we're not exactly sure what this loan forgiveness application is going to look like, but we're confident we're going to get 8 weeks of payroll, we're going to get 8 weeks of rent, 8 weeks of utilities, 8 weeks of all those other costs. It's just a matter of kind of how we're going to slice and dice them before and after. So that's why little extra tracking now to track not only what was paid, but what the period it was paid for. That will let us know if we get to the end of our loan period, if we need to make an early payment to catch that last couple days of the 8 weeks, we can. So what we're trying to do is put all of you in the position now to be tracking all of your expenses, so that if we need to make a payment at the end of our 8 weeks to cover that short period wages, that short period rent, that short period utilities, that you've got the record keeping in place to be able to do that. So to
expand on that as well, I think another thing that would be totally fine is you received a utility bill, say you got funded with your loan today, you received a utility bill yesterday for the prior 2 weeks or month or whatever it had been, and you pay that utility bill this coming Friday, for example. I think that's going to be totally fine to include that payment this coming Friday for your utility bill that you maybe received and was attributable prior to the 8-week period, as long as you're paying your bills in the ordinary course of business, how you would typically do things. You're not doing, you're not prepaying or post-paying anything significantly, but if in the ordinary course of your business, that's how you pay your bills, and it happens to relate to a period prior to the 8 weeks, I think that'll be totally fine.
Yeah, Dan, that's my hope too, and it hopefully doesn't have to get as complicated as it certainly seems like it could be now. Hopefully we get some more clarity in the coming weeks, but again, it's just to Paul's point and Dan's point early on, just more record keeping, more detailed record now will put us in the best position. So I know we did start a couple minutes late due to a technology glitch there, but I do want to respect everybody's time in terms of the 2 o'clock. We are going to stay on to make sure we answer all the questions that we had put together based on the preliminary questions. But I do want to wrap it up just really quickly. And for anybody that wants to stay on, we'll kind of stay on after the wrap up. So, first and foremost, would like to thank everybody that joined us today from wherever you're at. Hopefully, again, it's a beautiful day, just like we're experiencing here in downtown St. Louis. We appreciate your time. We know it's very valuable. The last thing, and Allie or Lindsay behind the control panel there, if you could jump to number 20 or our wrap-up question, that's kind of where I'll end things, and then if people want to stay on, we'll of course go from there. But the kind of wrap-up or the business strategy here, what can I do to maximize loan forgiveness And quite frankly, what do I do if I don't get maximum loan forgiveness? So the first part, we're advising folks now earlier in your 8 weeks, maybe you have been funded or are waiting for funding, but you're early enough now that with some relatively rudimentary projections, we can actually project out what we think we'll spend on payroll, rent, utilities. If we run those projections and we fall a little bit short of where we think we need to be, that's when we start getting creative with employee bonuses or transportation costs or all these other kind of things that are maybe on the fringe. So we recommend those projections to really see if you need to get a little more creative. We've mentioned it, but out on our COVID-19 Resource Center, we have a tracking model that we put together, or expense tracking model, that obviously can track your expenses as you go, but you can use that as your projection software in order to project out your costs. So as you sit now, I think the projection is maybe one of the most important things you can do. And then last thing to wrap up here, what if you don't receive maximum loan forgiveness? Either what if you don't project you will, or what if you don't get it? That's really dependent on the business owner's appetite for repaying the loan. So for some businesses that may not be fully operational by June 30th, if you're okay with a little residual loan and paying that over 2 years, that could be some operational cash in your business to continue paying payroll, rent, utilities. So we're not 100% hung up on maximum loan forgiveness if it's clear business strategy to keep some of that money behind. So loan forgiveness is important, but also we have to think about running our businesses and cash flow out beyond June 30th. So with that, we'll kind of wrap up the formal presentation here, but we will stick around because there's a couple other questions in the slide deck we do want to answer. So thank you for everybody for joining us this afternoon. If you stick around, we'll have a few more minutes, and if not, hope you have a great rest of your day and a great rest of your week. So Lindsay or Allie behind the scenes, I think if you jump back to number 16, that's where we left off. So Paul, with the banking background, this question's for you, and I've gotten it a lot. If I use my loan proceeds on other expenses, is that approved, or does that get me in any trouble?
Well, I think the easy answer in the spirit of time is absolutely it gets you in trouble. No, you can't use them for other things. And that sounds simplistic. And I know it's not. I know this is a real challenge for folks, but you have to use the funds for the items that it was determined that are appropriate to be used for. It has nothing to do with forgiveness, not forgiveness. It has to do with what the federal government would believe that fraud is involved. So, even though that you wouldn't intentionally do that, just make sure you're following those guidelines of the exact purposes we've talked about earlier in our slide presentations, out on the U.S. Treasury websites, out on our website. Use it for those things. Don't be tempted to use it for something outside of that, because that's when you could get in trouble. It has nothing to do with forgiveness.
Paul, I agree with you 100%, because if you remember that application that you submitted to the bank, there was certain boxes that you initialed and attested to that you're going to use this loan for the approved uses. So nobody really knows what the government will do if you don't use it on approved uses, but it is certainly a risky proposition to use it on non-approved expenses. Hopefully the loan itself will cover payroll, rent, utilities, free up cash flow for your other expenses, but it is a risky endeavor to use it on other expenses. So kind of along those lines, Paul, follow-up question, what happens if I don't use all my loan proceeds in 8 weeks? What happens then?
Well, obviously continue to do what you need to do as long as it's within the scope of the appropriate uses. But after that 8 weeks, they're not going to be forgiven anymore, and maybe that's part of your strategy. So what happens at that point in time when the recommendation comes back as to how much is forgivable? Then the rest of that is a loan that stays with the bank. It's a 2-year loan. It's at 1% interest. There's a 6-month payment deferral, so you won't have any payments until 6 months. The interest stays accruing, just as on any credit, but then at that point in time, it's amortized for the remainder of the 2 years. So it's not the worst thing that could happen as long as you've used it for the appropriate reasons. I don't know that I would significantly lose a lot of sleep, because I have to think that even if the amounts aren't forgiven, there will be smaller percentages that aren't forgiven. Most of the folks are going to get 60, 70% of the way there, and I think we'll get more guidance around that, and hopefully it will clarify some things. But as I said before, worst case scenario, 1% interest loan for 2 years to help fund your business. It's probably not a bad thing.
Paul, I agree with your point there, and what we'd hate to see our businesses, come up with quote unquote creative ways to spend extra money in the 8 weeks just to get forgiveness, and then after the 8 weeks have no money left to operate their business. So that's where my wrap up comment about the business strategy involved in this is, no, we don't want a huge loan to pay down over 2 years, but if we have a little residual amount left, that's just something we'd like to kind of leave with you to think about. Maybe that's not the worst case scenario here, as long as most of your proceeds are forgiven. So Dan, question for you, and we probably got this question asked 15 or 20 different ways, but what if my employees are not willing to come back to work during the 8 weeks, aren't able to come back? Or what if just there's other circumstances as to why my headcount or my wages may have been reduced in that 8 week period?
Right. So, as the slide indicates, with the guidance we do have, there are no other provisions built in for addressing this issue other than restoring your salaries and wages and full-time equivalent count by June 30th. We hope there will be some sort of provision or guidance that does address this. There are a lot of businesses that are not even allowed to open back up well into their 8 week period. For example, restaurants, hotels, retail businesses, they're going to need to address some sort of relief for that, whether that relief is extending, your 8 weeks or extending this June 30th date, whatever it may be. I feel like something has to come about to address this issue. But as of today, there are no other provisions that help deal with this specific issue. One other thing that is out there, I've talked with a lot of restaurant owners that are saying, my employees will not, or really anyone in retail, my employees will not want to come back because they're making maybe more money on unemployment with the increased benefits. Well, while the employer can't necessarily control this, the employee or prospective employee is technically not allowed unemployment benefits if they're offered their job back at the same pay and same hours they were previously, they previously had. So whether or not the employee, I guess, gets caught in that regard, they technically should not be receiving unemployment benefits if you've offered them their job back.
Dan, that's a really good point on the unemployment benefits, because for some industries, yeah, some of the service folks are making more on unemployment than they were at your business. So that's something that technically isn't allowed to happen. It's just a matter of if you do or don't report it, and our recommendation would be to report it, just so you as the business owner staying out in front of the law.
If you're an employer and you have an employee that is running into this exact situation, document via email, paper copy, and send it in the mail. Document in some manner that you offered them full-time, their normal employment back, so that it is on record, and you're kind of covering yourselves.
Right, and Dan, I think this is one of those times where we make there's a pretty clear statement that there's really no catch-all, or there's really no out if your employees aren't back by June 30th, but a couple unique scenarios were thrown our way, so I wanted to at least address those. So somebody asked, actually a few people have asked about maternity leave. What if you have somebody out on maternity leave? Again, right now there's no real catch-all to save you from that. They need to be, an employee needs to be hired back by June 30th, which brings up a point that you don't have to bring back the exact employee, but a new employee has to be back by June 30th. I
would agree. And if there was an individual who was retiring during this period, you still need to replace them. There are no provisions that address those issues of an employee being out for a portion of time or a prolonged period of time. So we have to operate with what we know right now, and that is restoring your full-time equivalents by that June 30th date.
Yeah, Dan. So there's a lot of other scenarios that can be played out in terms of, maternity leave or retirement or employment contract ending. And we can kind of go on and on and on with the various questions we've been asked, but really it all comes back to there's not really anything out there right now that allows for those things. You have to have the same amount of employees, maybe not the exact employee, but the same headcount by June 30th. So hopefully that answers a lot of your questions around that area. And then the last question in our slide deck that was from some questions that came in early. Paul, for you, folks are interested if they can apply for effectively a second PPP loan with the second round of funding. And then secondary to that, if there have been any changes related to being able to apply for an EIDL loan, or how would the EIDL loan grant forgiveness come into play with your PPP loan?
Okay. Yeah, and this thing just covers all bases, whether it's approval, forgiveness, all those types of things. But a company is eligible for only one round of the PPP funding. So once you've applied, got your funds, you're moving on to paying it out and getting forgiveness. If you haven't received funding, your application's in, stay the course. That's what you need to do. But I certainly wouldn't go around applying to different places. I think that slows things up, but you can only have one round. The EIDL loan, briefly talked about it very early on. It's sort of a mystery because it did have $60 million or $60 billion put towards it, but it hasn't as of yet, or at least 2-3 hours ago, had still not come out online to be able to apply for it. But it is out there. It has a little more flexibility on things you can pay, but it isn't a forgivable loan. If you do receive the upfront grant, which is $10,000, it does, though, reduce any PPP loan amount for forgiveness that you already have. So if you got the EIDL first, spent the $10,000, you can't double dip on the PPP side. So we've had a few clients, very few, that got through the process and actually received the $10,000 grant, but we are hearing more and more every day. So the last thing that I would just say, Dave, around this whole process is talking very early on to director of an SBA group here in St. Louis several weeks ago before this started. Keeping records, all of those things are massively important. We've talked about it before, but the government's not trying to create this as a got you type loan. They're looking for people to use it. They're looking for it to use it the right way. So keeping your records, if one I isn't dotted or one T isn't crossed, it may not be the worst thing in the world. Their goal is to make sure that the banks aren't stuck with a bunch of 1% loans, and more importantly, the clients aren't stuck with more debt. That's the whole goal in this. Conversely, use it for something else, it's going to be a real problem. But I think in the spirit of the law, everyone should be comfortable that everyone wants forgiveness on this, even the SBA.
Paul, I think that's a very good way to wrap things up today with our planned content. The spirit of this law is really, and a lot of the spirit of the CARES Act is really getting funds into individuals' hands. So related to PPP funds, we as business owners are getting funds into people's hands by paying a whole lot of payroll with the PPP. Unemployment benefits get funds in the folks' hands. Stimulus checks get funds in the folks' hands. So the spirit of this law is really to get funds into individuals' hands. And if you think about it from that regard, I mean, that's probably oversimplifying it, but that helps answer a lot of questions as to how you should be thinking about this. Lindsay, Allie, if you don't mind flipping to our last slide, we are going to share here in a moment for the folks still on the line, our contact information. Please feel free to reach out to any of us on the team to ask follow-up questions. We're happy to get those out. Thank you very much to everybody. I've been watching this live Q&A chat, and it's pretty impressive, the number of questions coming in. Our Wizards of Oz, Rebecca and Dan, have been great getting questions answered, but there still are some out there. So again, we promise we're going to get all those answered. We will post them all to our COVID-19 Resource Center, which you can access at our anderscpa.com website. So again, we really appreciate everybody joining today. We certainly hope that this helped clear up some of your questions, because we did want to take the approach of getting into some details and giving you our opinion and giving you what we think are some practical approaches here. So thank you, everybody. We will hopefully, as we get more guidance and as we learn more, we're going to share that with our COVID-19 Resource Center. likely more webinars coming down the pipeline. So we're going to do our best to keep all you informed as efficiently as possible. So thanks again, everybody. Have a great rest of your day and a great week.
Thank you.